The 2008 economic crash was a result of a combination of factors, including lax lending standards, a housing market bubble, and excessive risk-taking by banks and other financial institutions. The bubble in the housing market was caused by a combination of low interest rates, lax lending standards, and speculation. Many people were able to buy homes they couldn't afford, and many of these loans were packaged into securities and sold to investors. As the housing market began to cool, many of these risky loans began to default, causing the value of the securities to drop. This led to a loss of confidence in the banking system, and many banks and financial institutions were forced to write off billions of dollars in bad loans. As the crisis spread, many banks and other financial institutions were unable to meet their obligations, and they failed or had to be rescued by the government. This led to a severe credit crunch, and many businesses and households were unable to borrow the money they needed to keep going. The 2008 economic crash had a severe impact on the global economy, leading to the worst recession since the Great Depression. Millions of people lost their jobs, and many businesses went bankrupt. The crisis also led to a number of government interventions, including the Troubled Asset Relief Program (TARP) in the United States, which provided billions of dollars in support to the banking system. It took several years for the economy to recover, and the aftermath of the crash continues to be felt in certain areas, such as inequality and unemployment rates. The crash also led to a more regulated financial system and increased scrutiny on the banking sector. The 2008 economic crash, caused by the collapse of the housing market and the subprime mortgage industry, had a significant impact on the global economy and led to a financial crisis. The crash led to many people losing trust in traditional financial institutions and seeking alternative investments. In the aftermath of the crash, the idea of decentralized, digital currencies gained traction as a potential solution to the issues caused by centralized financial systems. This led to the creation and emergence of various cryptocurrencies, with Bitcoin being the first and most well-known. Bitcoin was created in 2009, just 1 year after the economic crash, and its decentralized nature and ability to enable peer-to-peer transactions without the need for intermediaries resonated with many people who had been affected by the crash. The 2008 economic crash had a significant impact on the global stock market. As the crisis unfolded, stock prices dropped dramatically, with many major indices losing over 50% of their value. The crash was triggered by the collapse of the housing market and the subprime mortgage industry, which led to a wave of mortgage defaults and foreclosures. This, in turn, caused a domino effect on the broader economy, leading to a financial crisis. As investors panicked and pulled their money out of the stock market, prices dropped even further. Many large financial institutions, including investment banks and insurance companies, failed or were bailed out by governments to prevent complete collapse of the financial system. The crash also led to a global recession, with many countries experiencing high levels of unemployment and economic contraction. The stock market took a long time to recover from the crash, with many indices not fully recovering to pre-crash levels until several years later. The crash also led to increased regulations and stricter oversight of the financial industry to prevent similar crises from happening in the future. The 2008 economic crash had a mixed impact on the industry. On one hand, the recession led to a decrease in overall economic activity and a decrease in its spending, as businesses and organizations cut costs and reduced investments in technology. This resulted in a slowdown in growth and a decrease in demand for its products and services. On the other hand, the crash also led to some opportunities for the industry. As businesses and organizations struggled to survive, many turned to technology to automate and streamline their operations, reduce costs, and improve efficiency. This led to an increase in demand for its solutions that could help them achieve these goals, such as software for automation, data analytics, and cloud computing. Additionally, the shift to remote work and e-commerce, driven by the pandemic, have accelerated the industry growth, as businesses and organizations have had to quickly adapt to the new reality. Remote work and e-commerce rely heavily on technology and internet infrastructure, so the industry has played a crucial role in facilitating this transition. Overall, while the 2008 economic crash had a negative impact on the IT industry in the short term, it also presented opportunities for growth and innovation in the long term.